G'day, Ziggy here, author of Money Does Grow on Trees. Today's guest represents one of Australia's most enduring investment institutions. In a world that's obsessed with what's new, fast, and exciting, today's conversation is about what actually lasts. We're going to explore what long-term investors think, how they manage their way through market cycles, and how discipline and patience are such powerful advantages. I'm joined by Geoff Driver from AFIC, Australian Foundation and Investment
Company.
AFIC.
Well done.
AFIC. So tell me, what in your experience do investors get wrong, Geoff?
Oh, that's it. You hit me with a hard question right up front. I thought we were going to go a bit easier than that.
Well, I know you break for the Bombers, right? So I wasn't going to ask that question.
That's right. That's exactly right. Look, I think they can sometimes panic at the wrong time. I think sometimes they can follow momentum at the wrong time. There's nothing wrong when investing in sort of assets outside the norm, but what can happen is when you've got good long-term investments and perhaps in certain markets they underperform, they then try and chase another fund manager or investment or stock that looks hot at the time and invariably switch at the wrong time. I think that's probably the key lesson. I think you need to have a well-disciplined investment approach for yourself personally, and you need to stick to that and not get caught up in the noise of the markets that sometimes that can produce at the end of the day.
Yeah, I don't know if it's produced anymore, but years ago we used to there was a chart, and it used to show the different years, and it used to show every year the returns of every asset class, and then who performed one year and what they did the following year, which was usually underperform. So you're right, as you're saying, if people chase the momentum necessarily and what was good last year, then they're going to continue.
Yeah, I think that's right. I think, you got to understand why you're investing at the end of the day. What are you actually looking for? Why are you investing? So if I take it back to what we represent, a lot of our investors are looking for that sort of long-term capital growth, but they're looking for consistency or growing dividends over time. So, that's what we represent. So if that's what you're looking for, you really need to be focusing on those sort of investments that are going to give you that sort of outcome. And I think that's important.
Yeah.
If you start drifting away from your own investment philosophy or approach, then you can get caught up in the market noise. And I think the other thing, what invariably happens too, is when you've got a stock that you've held for a long period of time and it's gone down and down, you think you can hold on to it, it's going to bounce back again. That's not necessarily the case. So often those stocks go down for a particular reason. I think that's the other thing that people need to understand. But I think sticking to your investment philosophy, what you're looking for from your investments is the most important starting point.
Well, tell us about AFIC.
So AFIC's been around since 1928 and getting back to really we're very much a long-term investor. It was started up back then to allow sort of retail shareholders, people with often not a lot of money, to actually invest in a diversified portfolio of Australian companies and really to benefit from that compounding growth over a period of time. So we tend to focus on companies that are what we classify as quality. They've got good businesses, businesses that can grow over time. The businesses are unlikely to be disrupted too much by external influences such as government policy. We don't get them all right, so don't get me. It's not a perfect portfolio
Yeah.
at the end of the day. But that's the sort of philosophy. We certainly look for companies that have got solid financial positions and sound balance sheets, because what invariably happens, we saw it through the GFC, that's how far we go back, that when the market turns against you and interest rates start going up, those companies that have got poor balance sheets or poor positions in markets in terms of the businesses they operate, they're the ones that get invariably hit first, and often they go under. That's the other part about it. So we're very much that diversified portfolio over a long term. We are not a business that runs an external funds management business, so it's low cost. So our MER, management expense ratio, 0.11%. So if you think about external fund managers looking to actually make a profit out of managing a portfolio, their fees are often 1% plus performance fees. So the real benefit of scale goes back to the end investor. As I was talking about earlier on, it's very much about long-term capital growth, so benefiting from the compounding returns that companies can provide to you in terms of their reinvestment, in terms of their own businesses, but also looking to grow and increase dividends over time. And we very much, because of the company structure, you get fully franked dividends along the way all the time. You don't get any other unintended tax consequences from the distribution.
Which in Australia, that's a real big advantage.
Absolute massive advantage at the end of the day. One of the few countries in the world that has it, but and we think it's an appropriate benefit because the companies pay tax already. So why as an individual get taxed twice?
It was Paul Keating
that's right,
made that
Paul
change,
Keating, and he's defended it ever since.
Yes, yes. Well, let's hope no one changes it.
Well, there's been a couple of goes. I think Treasury are probably thinking to themselves that it's quite a big benefit to. Well, quite a bit imposter, if you want to call it that, on the budget.
Yes.
But ultimately, if you think about the benefit it provides in terms of self-managed super funds and what have you, people actually planning for their retirement and have built nest eggs to not really rely on government in retirement, we think it's a perfectly appropriate mechanism to have in place for people.
Yeah, and I do want to come back to the philosophy and the companies and even give us a few examples.
Sure.
But just before we do that, tell us about LIC, so listed investment companies.
Yeah, again, so
It's a completely different structure than what most people tend to understand.
Yeah, and look,
through
when
managed
I
funds.
first joined many years ago, I called it a sort of secret society because not many people actually, only clients of certain stockbrokers actually knew about them because they're the ones that actually actually promoted those companies to retail investors. So as the name suggests, listed investment company is a company structure. So just like a BHP or Woolworths, it takes capital from investors and takes that capital and invests it into a diversified portfolio of shares. Now, I think, in a market now which is a lot of noise around ETFs and what have you, and exchange traded funds and open-ended funds, we keep coming back to the principle of what do LICs, why is there a benefit to LICs to investors? We think there's two main ones. The first one is it's not dictated to in terms of the way it invests. So if you think about an open-ended fund, when the market's running hot, they've got to buy stocks or stuff along the way. And when there's a sell-off in the markets, they've actually got to sell things to get out. And quite often that's the period where we get the best opportunities to actually buy companies we like. Because of that closed-end fund structure and the patience of capital, we can sit back and say, okay, we've been looking at these companies for a long period of time. These are the prices we want to buy at. And invariably in those sort of market dislocations, that's the best time for us to buy. And ultimately, investing is about buying something at the right price. And that's what we are looking to do, buy a good company at the right price. The other benefit, I think, is, as I suggested earlier on, is the fact that you just get fully franked dividends. So because of the company structure, if we do earn income, we either be able to pass the franking credits we get from the companies we invest in straight back to our shareholders, or if we earn income that's not taxed, it's taxed within the vehicle, and we pay 30% on that. So invariably, when you get a distribution statement from an LIC, what you get is fully franked dividends and nothing else. There's no hidden tax imposts that you might get with an ETF, which clearly has capital gains, capital gains tax in there and those sorts of things. So it's a much simpler structure for people. And I think the other thing about it, because it is a company structure, we can put reserves away both in terms of franking and also profit. So again, typical example, when the market cut its dividends by 25% through COVID, clearly the economy was under pressure, and a lot of the major companies cut their dividends, we kept our dividends the same. So for a self-managed super fund or people looking for income or dividends as part of their total return, it was a great benefit to those particular shareholders, the investors. Yeah.
And is that because you were building up reserves?
Yeah,
over time?
you don't tend to pay them out all at once.
Yep.
We tend to, as I said, the policy, particularly for AFIC's, stable to growing dividends. But if you think about the LIC structure, that's the same for all closed-end LIC structures around the place. Some will have reserves, some won't. And that's where, like any investment, you need to look at which LIC you're investing in, what's their cost structure, what's their long-term performance like, what's their dividend policy.
Yeah. So how many LICs does AFIC have?
Well, we don't. We have 4. We run 4.
Yep.
AFIC's a sort of long-term growth and dividend income. We run a fund called Geoff Investments, which actually... so actually it's about 10 billion in size, so not insignificant. Geoff is about $1 billion, but what it does is actually looks to enhance income by writing call options over stocks within the portfolio. Again, not something that a retail investor can invariably do, or it's hard to do, because there's a lot of management involved in those. So by writing call options and generating additional premium income, you're actually able to provide an enhanced yield to investors. So currently, I think the yield on the market, if you take into account franking, is about 4%. Djerriwarrh's enhanced yield in terms of fully franked dividends about 6.6%. So it's another 2.5% higher than the market. Now, you won't get as in financial markets, nothing's free. So if you're writing call options, they clearly don't get as much capital upside, but the income is the important part about it. Mirrabooka's our small mid-cap fund, so anything outside the top 50, had a great long-term track record. Again, looking at quality companies, mostly industrial companies, not a lot of resources in that particular portfolio. And AMCIL, which is a very small one, which is sort of our best picks portfolio, which is much more volatile at the end of the day. So we run 4. But there are certainly a number of LICs available in the marketplace, that's for sure.
So I assume there's not a lot of movement within the fund, a lot of too much by way of transacting.
Well, we look to be tax effective. So if you think about if you're turning over the portfolio significantly, you actually are paying a lot of tax.
Yes.
And that's what is lost, I think, when people start to what I'm trying to say is look at different funds at the end of the day and look at their performance. A lot of funds actually report pre-fees and pre-tax.
Yes.
Our performance is reported post-tax and post-fees. So you've got to understand what you're actually getting in terms of that return back into your pocket at the end of the day.
Yeah, and that's slowly starting to change. Everyone's sort of, trying to be consistent with net of fees, net of tax.
I think net of fees is much more obvious one.
Yes.
Some are going down net of tax, and appropriately they should do, because again, that's what the investor actually gets at the end of the day.
Yep. So coming back to the philosophy
Sure.
in terms of those LICs, if I'm an average investor and I look at it and let's say I've got a balance to say a moderately growth risk profile, and I want to consider an LIC, what would be one that I would consider with AFIC that was just tried and true? Long terms, the benefits,
I'd
as
still
you
go
said.
for AFIC if you're looking for moderate growth at the end of the day, plus consistency of dividend. Mirrabooka's obviously small mid-cap, so clearly that's a different risk profile, but I think in terms of growth, it clearly have more growth stocks in the portfolio. So it's something, in the case of Mirrabooka, with the probably portfolio turnover is 25%, which is still low in the context of what portfolio managers actually do. When we sell something at a profit, we generate a realised capital gain, we can actually use those capital gains as paid as fully franked dividends. So you'll still get a good yield on Mirrabooka, but you'll get more growth within the portfolio. And if I think about it's been in inception 25, 26 years ago. Mm-hmm. If you go back to that period, it's actually outperformed the ASX 200. So that's the sort of one where you get a lot more growth. AMCIL's much more volatile, and as I said, Djerriwarrh's probably more for people in self-managed super funds coming up to retirement, those sorts of things. So you actually really value the franking credits and the income and the stability of income along the way.
Yep. Yeah. Have you got some examples of sort of household name companies that the people that are watching, that you've got, say, you got in for the following reasons or you got out for the following reasons? Is there any sort of case studies like that?
Well, I think AFIC in particular, the portfolio turnover is only 7%. So there'll be some things that they've been there for a long time. I think Coles has been in the portfolio off and on since 1928. So that and BHP in the same context.
Yes.
But I think more recently you've got things like, we were early investor in car sales, for example.
Okay.
Early investor in realestate.com, for example. We were an early investor in Goodman Group, but really through a process where we understood the Goodman Group went through a sort of a major change in their philosophy, because they nearly went broke many, many years ago. But with the change in philosophy around how they're managing the business and what segments of the market they're actually targeting, we think they're a really good long-term investment for us at the end of the day.
Yeah.
In terms of getting out, as I said, we try not to make too many mistakes. I'd say Domino's Pizza was one. It's we were like all these things, very confident about, well, not confident, but very taken by the management team and the growth that they had within that. But we bought it at the wrong time. We bought when the market was running very strongly on that. And again, that's a great lesson. And investing is about learning your lessons along the way. You can't get everything right, as I said earlier on. So Domino's Pizza would be one that we clearly got wrong. and more recently for AFIC, WiseTech Global. So we're an early investor in that as well. Seen it go up, but with issues around governance and what have you. And we think governance and people are a really important part of assessing a company. We've decided, given the issues around that, we sold out more recently. So they're the sorts of things that philosophically will drive the changes within the portfolio.
Yeah, awesome.
Yeah.
I was going to ask what I know AFIC purely an Australian
And New Zealand.
and New Zealand.
Yes, yes.
We love our New Zealand neighbours,
that's
don't
right,
we?
yes, yes,
Don't we,
yes.
Danny? We love our New Zealand neighbours. What's the influence of AI in Australian companies?
Oh.
Right, because I was reading an
yeah.
article, Sam Altman, who's the CEO
Yeah,
of
sure.
OpenAI.
AI, that's right.
Apparently he's invested in something like 500
Yeah.
different AI companies.
Sure.
And OpenAI and all these, even Meta,
Yeah.
are just pouring money in, because it's just like, you know, even if we lose half of that money, we've got to be in it. We can't not be in it. Yeah. So tell us about the impact of AI in your philosophy.
Well,
and
it's
your
really
investment.
interesting you talk about that, because this is we've had a couple of investment committee meetings over the last couple of weeks, and this is an interesting subject that's been sort of dominating it to some extent. And it's been dominating it because not necessarily concerned about the underlying investments we have, but clearly the market, the share prices of a lot of technology stocks have been massively impacted over the last 2 weeks. You've seen, something like car sales go from, at the peak back in December at $40 to about $27 now. So you've seen massive changes in sentiment, and that's what's sort of driving it around, or that's what seems to be driving a lot of those companies in terms of their share price perception around AI. So we've obviously discussed it quite a bit. I think the point you made is a lot of money's being invested in it at this point in time, and no one's exactly sure how that's going to play out in terms of returns. So, quoting Sam Altman, they can put billions of dollars into these things, but they're willing to lose half of it. As an investor representing retail investors, we have got to be very cautious about how we go about investing our funds for our shareholders. And I think the point about AI is that if you've got a good business, good enterprise business with strong customer relations, and you offer a marketplace that actually can deliver value to the end customer, AI is going to help those particular companies in the processes they have to do that. But they're not going to take over the marketplace or the customer relationships a lot of those people have, or those businesses have, both in terms of business to consumer and business to business. And I think people will be very cautious over the long term about how that works. We're talking about that, and I'm not saying there won't be some companies affected by AI, clearly, but and it'll dominate the upcoming reporting season. Most companies will have to have a discussion about AI within their deck of reporting on performance and results for this upcoming season. But we were talking about in the context of GLP-1, which was obviously the weight loss drug, the impact it had on the ResMed share price probably 12 months ago. It was going to completely change the whole market for ResMed, because people will lose a lot of weight, they won't have as much sleep apnea, those sorts of things. Well, in fact, and that gave us an opportunity to actually buy. And that obviously their share price has recovered since then, because the underlying business is still sound, the underlying demand is still sound. It's perception in the market that changed. And again, getting back to your original question, sometimes perception in the market is not necessarily reality.
Yeah.
And you've just got to be very careful about that.
Yeah. So you guys are really looking at how AI will make businesses more efficient to create extra value, which
right, and how they pass that value back to the end client. So I don't think they can keep all of that value for themselves. They'll have to pass some of that value back to the end client, and I think that's where we're heading with this. And certainly the market recently has overreacted again, a bit like data centers. Flavour of the month, not so long ago, all of a sudden, a lot's being built. People are concerned about locked-in contracts, what income streams are going to generate, how are they going to power these things, what water's going to cost them. So you're seeing all that sort of change as well in the market. So.
Now, you and I have been around a while, and by the colour of your hair and the colour of my hair, right? And
we're both Essendon Carlton supporters. You have to be around for a long time for success, but anyway.
That's right, the last time. How long has it been since the Bombers have been in a final?
2004 I saw the other day.
Okay,
Yeah.
how many days? I think.
Oh
it's
no,
two-
we had
two-
been the final. Won the final.
Oh,
sorry.
won the final. Yeah, that's right. That's
Yeah.
right. And it's been 30 years, 31 this year since we've won a premiership. So I forgot the question. That's
right.
funny. You're talking about bombing.
Yeah.
No, what I was going with was that. So we remember the obviously the GFC, but before that you had the tech wreck.
Yep.
Right, and you talk about flavour of the month. You're talking about,
Yep.
I remember when the internet came out, it was just
Yep.
like e-commerce.
That's right.
It's going to take over the
And
world.
a lot of the companies were unprofitable at that point in time, and the tech bubble just kept going and going and going.
Yeah, and all these resource companies, I remember at the time, were changing the name from, Golden State Resource, whatever it was, to VoiceNet, to
That's
DavNet.
right. That's right. Yeah, all these shell companies.
All these shell companies are going crazy. So there's obviously a bit of steam in what's going on now with AI
and gold and
gold and silver.
That's right.
Yeah.
Absolutely. So there's a lot going on in the market from that perspective. Absolutely.
Yeah. So how do you guys then? I guess if you've been around for a while, you know that this is just one of those other things. Because as an advisor, when the market corrects itself, I usually anticipate not the timing of it, but if we've had a good run like we've had for sort of 3 or 4 years, then I'm telling clients, say, listen, we're due for a negative year, so be ready.
Yeah.
And therefore, when it comes, it's just like, okay, I knew this was coming, I just didn't know when.
That's right.
So I guess you guys in that investment world would be doing it similar. So, okay, well, this is the same thing. I mean, 100 years ago it was tulips, red tulips, and, now
longer.
it's longer, 200, whatever it was,
That's
and
right.
now it's this.
Yeah. It's a really interesting question because I think so one of the charts we have been showing more recently is about where our share price, the LIC AFIC share price, has been trading against net asset backing per share. And what we've seen is
just explain that, Geoff, because a lot of people that won't know.
So because we're a closed-end fund, if you think about the mechanism that we're buying and selling goes on, so an open-ended fund like an ETF, the buying and selling goes on the market, and you basically buy and sell what the market's worth at that particular point in time, or that basket of shares or whatever you may be in the ETF. For a closed-end fund like AFIC, which has got about 70 stocks, the let-out or the let-out valve, or the valve that actually allows you to buy and sell, is the share price traded on the market. And sometimes the share price can trade higher than what the net asset value is, and sometimes it can trade lower. So we've gone back since 1989 to look at where the share price has traded relative to net asset backing over time. We traded at a big discount just prior to the GFC. Prior to the tech bubble.
Right.
Big discount just prior to the GFC. Big discount just prior to COVID. And of course, when all those unwound, we went to a premium all the time.
Right.
We are now trading at 10% discount.
Okay, now I know what to buy. This is not advice, by the way, but now I know.
So we say to ourselves, well, it's funny, you look at the history around that, you suggest that perhaps something's going on in the market, as you're suggesting earlier on. In terms of managing the portfolio, which is obviously the original part of your question, we just got to look at the opportunities that volatility can provide and not get, back to where we started off talking about this, not get caught up in momentum plays. We know we want to invest in good quality companies, strong balance sheets, good management, strong business positions, blah, 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 to actually build that portfolio as a long-term investor. And so we've got to be very careful not to shift away from our investment philosophy and thesis. And often when we get those big market downturns, we'll have some cash, we'll have availability of cash to actually go in and buy good quality companies at good prices. And that's what we're really trying to do across all of the portfolios we manage. Now, at the moment, that's really hard because, as you said, the markets are running so strongly in different areas, and we're probably getting punished a little bit from that in terms of short-term performance. But the worst thing we can do is actually just try and chase momentum. Worst thing we can do. And what we're also trying to do is make sure we keep our dividends along the way consistent and growing, because if you think about it, that's the other way we can reward shareholders in terms of having the patience with us, and that's what we're trying to do.
Yep.
And that's how we construct the portfolio.
Yep. Okay. No, that's good.
Yep.
That's good. Investors coming into the market that are fairly new, obviously the message is, hey, we're in it for the long term. We're looking for good quality. But to an individual investor, what would you say other than, hey, we're heading for the long term, but that long term is different for different people.
Well, exactly right. And so I think it gets back to what again, what I was talking about earlier. What is your objective in being in the market? So we have a lot of people invest on behalf of their children and grandchildren. So they just want to put the money in, put them in the bottom drawer, and just let it compound over time by reinvesting their dividends. And we have a tax-effective way of reinvesting those dividends as well. And 20 years later, they've got a good corpus of funds there at the end of the day. So that's one way of doing it. I think for a new investor coming into the market, you've got to look at long-term performance. Fees are really important. Again, you don't want to be. There's nothing wrong with high fees as long as those fees can be justified. And again, you've got to look at that over a period of time. I think the other thing you spoke about earlier on, if you look at the league table of fund managers, their 1, 3, 5, and 10-year numbers can be very different. So in 1 year they can be very strong. Look at over 10 years, they might be at the bottom of the league table rather than the top. So you've just got to understand, what they're actually investing in and what you're looking to get out of it at the end of the day. In terms of individual stocks, again, just don't get caught up in the momentum. Look at the long-term history of these in terms of valuations and dividends, and understand the quality of management. Because you really, ultimately, if you, as an investor, what you're taking your funds and investing alongside the people actually managing the business. So you've got to understand it, whether they're acting in the best interests of you as a shareholder, and they actually have got a good business that they can grow over time by reinvesting funds within that business.
So if AFIC aren't changing in their LICs, they're not chasing the momentum and not chasing the share price, let's say,
Sure.
then does that mean you're sitting on some cash typically at around about this time?
We don't like to have a lot of cash, but yes, this is probably more so than we have in the past. We think people invest in us because they want to be exposed to the equity market, and so we don't want to. We don't want to be trying second guessing the market in terms of having 5, 10, 15% cash and taking it. We're not trying to second guess or we're actually not trying to predict what the market's going to do. We want to get back to the basics of investing in quality company. I know it sounds really boring, but that's what we do. Get back to investing in the quality of the company, because we know that's got to grow over time, and therefore not have a lot of cash and try and second guess the market, because that's just not our style. And invariably, I've seen a lot of fund managers go to a lot of cash, and it hasn't worked for them as well.
I've got. I heard an advisor recently recommending his clients go to cash before Christmas.
Yeah, right.
Yeah. So and when I got told, it was from a client who'd heard it from someone else.
Yeah.
From it was their friend's advisor, and I said, "Oh man, the advisor's still trying to be that cheeky with the market?"
Yeah. Well, look, again, it depends what the portfolio they've got is like, of course, as well. If
Yeah.
they've got a lot of growth and they've got great returns, and you think the market looking a bit toppy, you might take a little bit of that. I'm not offering advice either.
Yeah.
You might take a bit of cash, but if you held cash since December, the market's still been running strongly.
I get that part,
Yeah,
but
yeah.
then you're triggering capital gains tax.
Yes.
You got to account for that, and so you've got the exit costs, and then you got to go back in. And when do you go back in? No one's going to ring the bell.
And it also depends how they generate the cash. I mean, for my own personal, I don't reinvest my funds now. I take the cash as dividends, So that's how I build my.
Do you put that cash like we Greeks do in the mattress?
My wife's Greek, so.
Oh, is she?
Yeah.
Hey, look under the mattress. I bet you there's cash there.
No. I think she invests in jewelry. Anyway.
Gold and silver.
Gold and silver. That's right. Yeah.
Do you know what part of Greece?
Corfu.
Corfu. What a lovely island.
Yes, Ionian Islands.
I haven't
been there many times. Anyway.
Yes, love the Ionian Islands. They're nice and green on the left.
That's
there.
right. Exactly right.
We go a lot. My wife is from Rhodes.
Oh, that's right. The other way.
That's right. The other way,
and very volcanic.
It's a very volcanic and a lot
very
more
picturesque. Very picturesque.
But the Mediterranean is just gorgeous.
Yeah, it is lovely.
You look like you should be a Greek, Geoff. Should be a Greek. There you go. No, that's good. You mentioned before about governance.
Yeah.
And I think one of the good things about Australia is we have high level of governance. I know as an accountant, as a financial planner, there's a high level of compliance and governance. There's governance at companies, at company level, all different levels.
Sure.
In fact, you could argue that we're over governed, but that's a good thing from an investor perspective, isn't it?
Oh, absolutely. I mean, I think That's the basis, one of the bases of having an efficient capital market in Australia and elsewhere in some ways. You've got to be able to trust the accounts, trust the governance in terms of their compliance with continuous disclosure. You've got to be able to people have to be held to account if they're doing something wrong. That might necessarily happen all the time, but you've got to be able to have that confidence. People work hard to make their money at the end of the day, so they don't want to be putting into something that's going to be a bit more risky from a governance perspective. And from our side of things, I talked about governance in terms of the way we look at the people running the companies we invest in, that's very important for us. So we'll often meet with the chairs of the companies that we invest in. And again, it's another advantage of, I think, a listed investment company like ourselves. We actually meet with the management, we meet with the chairs of the companies, we vote on the remuneration reports, we vote on the proxies, we vote on the election of directors. So again, it's something that we think is a really important part of the governance process that we try to apply to the investments that we have within the portfolio.
Yeah, I like it. I think it's a big plus, certainly from an investment perspective. I think it gets over. If I go, because you go to Greece, right? So I go to Greece regularly, and so there where there's not as much governance, and it's sort of who you know, but the problem is there to get something done. It takes 10 times as long as what it gets done here. Right?
Although it's getting hard in Australia too, I suspect.
It is getting hard in Australia.
Particularly for financial advisors, I guess.
Yes, very hard. Hey, tell me, why is it, do you think, that your average person doesn't know anything about LICs?
Because they were traditionally marketed, sold, whatever you like to call it, through stockbrokers. The financial advisory industry didn't really have a great knowledge of them. And so I think, from that perspective, was a limited knowledge about them. What we've seen, I think, over the last 10 years or so, there's been a growth in LICs, but not all of them being good. So I'm not saying all LICs are good and the structure's fantastic for everyone. There's been a number that have come to the market that are very small. And if they're very small, you tend to trade at a discount all the time when you have less liquidity. So that's the other part of the problem I think we've had with LICs over the last few years. But getting back to your original question, I think we've employed Suzanne Hardy.
Employed some good people.
Yeah, that's right. To actually go out and talk to
there.
financial advisors, and we're getting a lot more traction there. The brokers are still interested in us, but a lot of brokers these days want to construct their own portfolios and those sorts of things. And ultimately, I think we have got a number of shareholders who have large amounts of money in us, but we obviously have AFIC's had 150, 160,000 shareholders. So a lot of them would have $50,000, $100,000 within that. So again, it's getting that diversification and spread across the market. So for a broker, if there's a small amount of money to manage, they might put us in LICs, but not necessarily in the larger funds. And again, for financial advisors and brokers these days, to actually provide advice to that sort of client is much more difficult given the costs associated with compliance and everything else that has to go with that process for them. So there's a bit of a market that's been left behind, and we think that's where LICs. Interesting enough, when self-managed super funds came to the market many years ago, we saw massive growth in listed investment companies, and we've still seen the shareholder numbers go up, which is good.
Yeah. And the future of it, you think it's pretty...
It's
1928, actually the year before the Great Depression.
That's right. Well, there's nothing guaranteed in life, as you well know, other than the sunshine in Greece, of course.
Yeah, that's right.
That's the only thing that's guaranteed.
That's guaranteed, and that's good.
Look, I think, again, there was an article in the Financial Review front page last week. LICs are dead, not a good structure for people. That's always been said pre-GFC, said pre-tech bubble, said pre-COVID, and invariably the structure's held consistent to what the investment philosophy and outcomes have been or trying to be for investors. And we still think they're appropriate for a lot of investors. They just need to understand the benefits of them.
Yeah, I think it's more of an education thing, and even with advisors.
Yeah, look, and to be fair, we haven't done a great job over the last many years because we invariably traded closer to NTA, but because the market cycle the way it is, and the pressure's on us to actually get out there and speak to people more. Because if you think about it, you're buying in AFIC's case, and there's some of the other portfolios you run, which are all running at discounts. You're buying 70 companies in a portfolio for 90 cents when they're worth $1 on the market.
Yeah.
So
Yep.
You've got that, you've got the dividends, plus you've also got, if the market corrects, you've still got that 10% leeway.
Yes.
You know, so
Yep.
we think that's a positive point at this point in time. But having said that, though, I mean, the market's run very hot in certain areas, and we've been left behind. So I
Yep.
think we just need to take a long-term view of these things.
Yep.
Yeah.
Yep. And look, dividends and compounding and
Absolutely.
it's boring investing, but
it's boring investing. We've got a 30-year chart, and it's a long time.
Yeah.
Without the benefits of franking, we're ahead of the index. You know, and if you think about it, that's after costs, and people have slept well at night,
Yeah.
knowing they've been in that particular investment. So
Yeah, it comes back to the tortoise and the hare.
that's exactly right.
And
yeah.
I've been the tortoise. I've been the hare. I reckon I'm more the tortoise these days.
Yeah, and look, you know, all investors are good in hindsight as well.
Yeah.
So you just got to be a little bit careful looking at hindsight and being too caught up in that. Yeah.
What's the one tip, just in terms of where we're finishing off? What's one tip you would give if I'm let's say I'm an accumulator.
Yep.
I'm a couple. We've got a few kids.
Yeah.
We've got maybe some. We've still got a mortgage on the home.
Sure.
We've got a super fund. Maybe an investment property, because
Sure.
that's always
Yeah.
flavour of the month. Although the government's very talking about
Focus on that, that's right,
potentially, maybe getting rid of the 50% exemption on the capital gains.
Well, reducing at least, I think.
Reducing at least, yep.
Yeah.
So what are some of the things I should consider, LICs aside? I mean, you can put LICs in there, but what are some of the things that I should be thinking of as
I cannot give financial advice, as you well know, or
Yes.
tax advice at the end of the day.
Yeah.
The things I consider, look, I think, that's a really hard question because it depends on the size of your mortgage, the size of your income,
Yep.
how much you've got in super. I always advise my kids, if I can go down to that,
Yes, that's a good
route,
example, yeah.
route, try and get your mortgage down as much as you can. Pay that off first. It gives you flexibility at the end of the day. Get as much into your super as you can, because again, that's the lower tax environment for you. And in terms of property and those sort of things, I'll leave that to the other experts. But that's what I sort of took to my kids as a starting point. And some of them have actually invested in the share market. And again, just benefiting from reinvesting in the shares over reinvestment plans over time.
Yeah.
Compounding is a fantastic benefit or fantastic thing for people to appreciate when they actually are investing at the end of the day.
Yeah. It's good advice.
Yeah.
It's good advice. And I think the share market overall, like LICs, but the share market overall is misunderstood, or not as understood as it should be by people. Because you get this whole debate of, the bricks and mortar. And look, I've got property and I've got shares,
Sure.
right? So, it's all about the bricks and mortar. See, super funds have got negative. See, they don't invest in property. You should be like, that's...
Well, some do. Industry funds do.
Lots do.
Yeah, that's right.
Lots
But
do.
I think, look, again, that's why you get back to understanding what the profile of your portfolio is. Look, equities are more volatile. There's no doubt about that, both international and domestic. So you will get those ups and downs periods. That's why I get back to the being patient, because patience and reinvesting through those periods, you can actually get a good return at the end. Look at the end game rather than actually focusing on the first quarter of the football match.
Yes.
When Essendon are beating Carlton.
Yeah.
What's going to happen. But, look
Let's
at the
not
first
talk about
part.
1999.
That's right. We're well in front of three-quarter time. Anyway, so let's see. Look at the end game. Don't worry about the short term, because
Yes.
you've got to be able to live with volatility. Otherwise, you won't sleep at night, And I think if you're investing in good quality fund managers or vehicles to invest with, then that's what's going to be important.
Well, thanks for. It's good to meet another. I was going to say another Greek, but another pure Aussie? Because your background Anglo-Aussie, is it?
Yeah, Anglo-Aussie.
Yeah,
that's
okay.
right.
Anglo-Aussie that's married a
Well,
Greek.
Driver last name, you'd expect. Anglo-Aussie. Who knows where that goes back, though?
Yeah, probably. So Anglo-Aussie, that you know who the best women are. All right, you do.
She treats me well. That's
Yes,
right.
she does. She
That's
does.
right.
I bet she looks after you. Mine
That's
looks
right.
after me, as you can
Yeah.
tell. Geoff, thanks very much for coming in. Appreciate it. And I think what we wanted to do was give give some information around LICs, around AFIC, and what, because I think that's misunderstood. It's not enough knowledge out there about it, and where it fits in. And it's been around for a while, right?
Yeah, that's
so it
right.
should
And
be,
it's an enduring investment for people, and it's been an enduring business. And we have an independent board of directors and high quality, and the governance there is very, very strong, which is very important again in investing it these days, particularly around some of the issues that have been happening more recently.
Yeah. Well, around the world, look at around the world.
That's right.
You wouldn't invest in 80% of the world at the moment.
That's right.
With what's going on. But anyway, thanks
Good.
for coming
Thanks,
on.
Ziggy. Really
Cheers.
appreciate it. Thank
Bye.
you. Thanks for your time. Bye.